Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Thank you very much. Just hit 100 subscribers on YouTube, so thank you to everyone who's subscribed. If you haven't done so, we'd greatly appreciate you hitting the like and subscribe button just to help out with the algorithms. And today, to celebrate, I'm going to answer some questions or do a requested video from a subscriber that wants me to speak more about the oil market, particularly the oil services being offshore drilling and the tanker freight market. And I started to do this video with them both. I thought I'll knock them out in one, and it just got too much detail. So I've decided to split them into two. We're going to talk about the tanker market today, and then in a later edition, I'll cover the rig market, which I think is extremely exciting for many reasons. Okay, so when I do a basic sector overview, I'm interested in supply and demand as the basic economic principles that they are. I personally like to start with supply. I know a lot of people talk about demand till they're blue in the face. Supply is, to me, easier to forecast or predict, and so I like to start with supply. So keeping things super simple from a top-down view, what are we interested in when it comes to the oil tanker market? So we're looking for the number of companies in the space, okay, obviously, so the number of competitors, the vessel numbers, okay, so how many of these tankers roughly are there in the world to be able to carry oil from one side to the other, and the trend, okay, so is the supply trend increasing or decreasing, and at what rate, okay, because we need to work out, is there going to be a supply and demand balance or imbalance to either side, to the demand side, to the supply side. That's what we're looking for. So companies in the sector, this is really easy. There's 5 or 6, and there's probably about 3 or 4 serious players. Vessel numbers for the very large crude carriers is around 810, and the trend is tightening. Okay, so from a super simple analysis, that is what it would look like. Here we're looking at the number of companies in the space, okay, so ignore the top and bottom. They are actually drill companies, okay, so rig companies, and these are the main players here, okay, so Frontline Euronav, Torm to a lesser degree, and I would say INSW and Scorpio tankers would be the big ones. And for reasons which I have explained in another video, my personal preference is Scorpio. That's how we in the Crassus investments and in my personal portfolio will be playing the oil tanker market. So let's have a look at the number of crude oil tankers in the global fleet. Crude oil tankers are different to enhanced crude oil tankers, okay, and Scorpio specifically carries more enhanced crude oil tankers and oil product tankers, which is another reason why I think they're one of the better companies. Let's have a look. So overall, you've noticed this is a growing market because we've got more supply coming online. However, that's a little bit deceiving, okay? So our deliveries and our demolitions, you can see down the bottom here. If you look at the deliveries, okay, which I'm interpreting to being the new ships coming on the market, okay, so new tankers, you'll notice that that has a rather steep decline of late. And so there's always a lead indicator and a lag indicator. So that would be a leading indicator that there's going to be a supply dearth in future that we would expect, and that lagging indicator would be perhaps utilization rates increasing because there's less overall carriers, and what would go hand in hand with that, of course, is increased daily rates that the tanker companies can charge. Okay, now let's have a look at the supply trend. So are we trending up or down in terms of the supply? Is this rate of supply coming online, not the overall supply, but is the rate of supply online, is that increasing or decreasing? Well, let's have a look. Ignore dry bulk. That's more for big container ships, okay? We're looking for the crude oil tankers and the oil product tankers, and down here. This is the demolition in the tanker market over the last year, okay? And it is significant. There have been more demolitions over the last, or the first quarter of this year, 2021, than there were in the last 2 years combined, as I mentioned with the video with relating to Scorpio. So let's have a look here. If we look down with this dark blue and light blue column, on the dependent variable here, we've got million tons of, or dry weight tons, okay, so that's in the millions. So we're getting, on a monthly basis, almost 500,000 dry weight tons taken offline. That's how much has been, or how much worth of capacity has been demolished, and that's now obviously, once it's done, it's out of the active fleet and can't be used. So that's the amount of capacity that's coming offline on a monthly basis over last year and this year, or the first quarter of this year and April. So we're obviously starting to have this trend where we've got more and more tankers being demolished, which I spoke about before, due to higher steel prices and less demand. And so now that supply trend is really starting to come offline. So when we're talking about the product carriers, so not the crude carriers, the product carriers, the rate of retiring vessels is accelerating, as I mentioned. And that's important for us because we're interested in this from a market and investment point of view. During the years of 2019 and 2020, 1.2 million dry weight tons of oil product tanker capacity was all that was demolished per annum. Okay, but, and this is what I mentioned before, 2021, the same amount of tonnage was sold to cash buyers. So they sold the ship for scrap metal basically within just 4 months for subsequent breaking. Okay, so we've got more happening in the first quarter of this year than happened in the last 2 years combined. Okay, so the rate of tankers coming offline is increasing. Demolition of oil product tankers is heading for an 11-year high if the current pace continues for the rest of the year, okay, which is very significant. These have been taken from ESGN, I believe is the website, and also from BIMCO, okay, who give a really good overall analysis of this market, and also the International Energy Agency. So if you're wondering where I'm pulling this from, I'm not going through and flipping it through different tabs. I think it's just easier for me to whack it on here. Don't alter anything. I just put it on here and then do a little bit of highlighting so you can see what the score is. It would then amount to 2.1% of the active oil product tanker fleet. Okay, so if you've got 2% of the entire fleet coming offline, that's obviously significant. And if we take the crude oil sector, to reach the same amount as a percentage of the fleet, you'd need to scrap 10 million worth of dry weight tonnage capacity, which is huge. Okay. So as a relative percentage of the product tanker market, there's just been a massive amount of supply that's been taken offline. Okay, a massive number of the fleets gone, sold for scrap. Crude oil carriers, okay, so despite the pickup in demolition for crude oil tankers, the shear level compared to the size of the fleet is lower than that of the product tankers. However, that's because I believe they're using a larger denominator over which to calculate the percentage. So if we come down here, we'll see that what matters is only the active trading very large crude carriers and not the floating storage operations, that's what FSO stands for, or offloading units, are used in the calculation. So I think what they've done is they've simply, if you imagine the numerator, number of crude carriers for demolition at the top, over, in brackets, VLCCs plus FSOs, and then you get a percentage. And because you've got the FSOs in there, that denominator is artificially large, and so that fraction has been made smaller than what it is in reality. You can imagine if you remove FSOs from the denominator, you're going to have a larger fraction, or in this case a larger percentage of the fleet that's been demolished and come offline. So I think that's going to surprise a lot of people. And here we have the rate of growth for the product tanker fleet. Okay, so here obviously you've got your deliveries, and then down the bottom you've got your amounts that have been demolished. They've measured them in the capacity units of the tankers that have been taken offline or put online. And so here you've got your rate of growth. Okay, so rate of growth of capacity coming into the market, and the trend is followed by that orange line. Okay, and so as you can see, the rate of change is decreasing thanks to more expected demolitions coming in here at the end of 2021. And so again, we've got this wonderful situation where, well, it's not wonderful, but if you're from an investor, you can start to get excited, where the supply is starting to diminish, and if the demand just simply stays stagnant or increases, the relief between the two has to be the price. Okay, the cure for low prices is low prices. Aging vessels. Okay, so that's all well and good, that things have been starting to decline, but if we have a whole new lot of new vessels coming on that are going to last for 15 to 25 years. Euronav suggests that really for the enhanced crude oil tankers, their lifespan is no more than 15 years. Once they get to 15 years, they're too hard to upkeep, and they go to either floatage storage operations, or they carry something else other than the enhanced crude product. So if we've got a heap of vessels still that are going to be not demolished this year, but next year and the year after and the year after that, that is something that we want to make note of. Okay, so 25% of the global fleet is expected to be over 25 years old by the middle of next year. Okay, so by next year, you've got a quarter of the entire global fleet that will be, or should be, according to Euronav, too old to operate in the enhanced crude space. Okay, so that's significant. You might have, again, a huge amount of decreased supply by as soon as the middle of next year. So think about what is that going to do to the day rates of these tanker companies? Okay, they should be, all else being equal, they should be going through the roof. 60% of the global fleet will be more than 15 years old by 2024. Okay, again, so this is not just a quick spike on the radar. This is going to be a supply problem for years to come, and this market has some legs on it. We can expect it to last at least into 2024, 2025, according or taking the supply numbers into account. And this is an idea of who owns the most carriers and the average age. So this is why I, as I mentioned in the video, prefer Scorpio. I suggest you click on that video and make sure that you watch it to give an in-depth analysis. But you can see here the average age is represented in this orange bubble. And so you can see they have a younger average age of their fleet versus some of the others. And so you can see here, coming up on 15 years, those particular competitors in the middle are going to have a hard time adapting when it comes to carrying. And obviously COSCO is taken out of it because that's a freight and cargo carrier, but TORM and International Seaways do have quite a bit of their revenue coming from oil transportation. Now let's look at the demand side. So we know that supply has dropped, is continuing to drop, and is likely to drop even further into the future. So that's interesting. We're looking for the demand for the particular commodity. Okay, so we want to know, is oil price going to go up because people want to use more oil than they have in the past? And that's obviously going to drive service demand. So if we are owning a company that transports oil, but no one cares about oil, then no one's going to be interested in paying us to take their oil from the drill site out to the refinery and then on to the rest of the world, so to speak. And that will obviously drive the services profitability once you have your rates. Okay, so the amount that we can charge customers as the owner of the tanker company has to be greater than our operational expenses. So operational expenses for most tankers are around about the $25,000 to $35,000 a day US. Okay, and so once day rates hit that point, they're break even. So that's what we're looking for. Commodity demand. Okay, as I've spoken about quite a bit recently, oil demand is surprising people for some reason. I don't know why. We've got, call it 6 billion people, 6.5 billion people in the developing and frontier worlds that are going to double in population over the next few decades. They are going to want to live, presumably, and use electricity. Even if the usage per person stays the same, which is at about 3 barrels per person per year, that will still add another 50% to the global energy demand, even if they don't increase that at all. Okay, so obviously the demand curve is still going to be a steady rise until maybe 2040, 2050. In terms of the pandemic, obviously things fell off a cliff because everyone was at home and no one was using as much energy as they normally would. But it's interesting to see that the International Energy Agency, which is where I got this info from, are expecting demand to return to pre-pandemic levels by the end of next year. Okay, so end of 2022, we'll get up to a growth rate of nearly 5.5 million barrels a day, and then again another 3.1 million barrels a day next year. Okay, so talking here, this is talking about stock. Okay, so above ground stock that's been in storage. When everything happened in March last year, demand for oil fell off a cliff, and so basically you had these floating storage tankers just doing figure eights in the ocean, holding on to the oil that nobody wanted. Okay, so we're starting to chew through that supply. Okay, here we have industry stocks held steady in April, but fell 1.6 million barrels below the pre-COVID average for the first time in more than a year. So that tells us that we're starting to run through that existing above ground inventory, and this was at the end of the first quarter this year. Okay, crude oil held in short-term floating storage declined by 6.8 million barrels to 99.4 million barrels in May, its lowest since February 2020. So again, that's illustrating the point that the above ground supply is starting to be chewed up. Oil since then, okay, oil recently just crossed $80 a barrel again, so that tells you that the price is indicating that the demand has really started to resurge for oil, and with the world reopening again, airplanes flying and so on and so forth, more travel, more commercial activity, more manufacturing, etc., that is not going to change anytime soon. Okay, here's an interesting observation. Our first detailed look at 2022 balances confirms expectations that OPEC Plus needs to open the taps to keep the world oil markets adequately supplied. So what that's saying is, again, reaffirming demand is so strong. If OPEC doesn't open up the spigots and start pumping more oil out into the world, we're not going to be adequately supplied. And if we've got a demand and we're not adequately supplied, the relief from which is always the price, and the price has to rise in order to either bring supply up to that level or to curb demand down to the level of supply. Very simple stuff. Global oil demand will continue to recover, and in the absence of policy changes, by the end of 2022 reach its 100 million barrels a day. Okay, so easy. It might even be a little bit more than that, who knows. Here's our a quick look at where oil is produced in the world, okay, and where it's consumed. And you'll see in a lot of places that the consumption is higher than the production as of 2019, okay. And what's interesting is the refinery throughput often outpaces the capacity of refineries. So you don't just pull out oil out of the ground and then it's good to go. It has to go to refineries, and how does it get there? It has to be transported, and who transports it? Oftentimes the tankers. Okay, so that's us. There's going to be huge demand in getting oil from the production site to the refinery and then to the end user. Again, this is a great chart that I've used before, showing how back in May, when oil futures were negative and nobody wanted to touch oil, you just had to leave oil in the middle of the ocean on these tankers just driving around doing nothing, okay? And so there was no demand for true transport, as in taking oil from primary production site to the refinery and to the end user, boom, 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 which is what the true tankers are involved in. So they had to lower their day rates. Okay, all of a sudden you got no customers, you can't charge premium daily rates, you got to drop them. Okay, but as you can see, this looks like a ski slope. We have very, very little product floating storage compared to where we were. So we're chewing through that above ground inventory, and pretty soon the demand for tankers to take your oil from one side of the world to the other will start to continue to pick up, not start, but continue to pick up. Crude oil tanker earnings, okay, not very pretty. From last year, you can see, as I mentioned, we'll call the average break-even rate for most companies around about $30,000 per day. Okay, so if you're charging your customers less than $30,000 per day as a tanker operator, you're losing money. Okay, tanker operators or tanker operating is an expensive, capital-intensive business. Okay, so as you can see, where we are now, coming into the end of 2021, that seems to have bottomed out and is starting to resurge, but we are nowhere near break-even rates. Okay, so there's a lot of price relief that needs to rise, and that will rise alongside the oil demand and the oil price itself. This is a better chart. Why is it better? Let me move my face out of the way, because we have a longer time period. So if we go back to here in 2015, towards the end of the bull market in oil for 2014, you can see crude carriers here, okay, their day rates were at about 70,000 US, okay, so nearly 10 times what they have been recently. Okay, so we got a 10 times if we just revert back to 2015, which was an okay year for oil, but it wasn't, the best, through to 110,000 a day. that is a significant potential upside for the oil tankers. Okay, so we've got to figure out who's likely to win that race. But in terms of the general tailwinds for the sector, if we were to get back to oil prices around the 2014, 2015 level, it would stand to reason that day rates would, if not get back up to that level, they would certainly get close. Okay, thanks very much for watching. If you haven't already liked and subscribed to the channel, we greatly appreciate you doing so. And for those of you that are interested in the portfolio, I run a portfolio on eToro called Crassus Investments. Click on the link that I'll leave in the description and you can add us to your watch list and keep an eye on the fund and see how we're choosing to play the oil market. Or if you've got some funds and you like the way that we invest, you can just add an amount that suits you and then copy the fund and become one of our copy investors. Disclaimer, as always, I'm not a financial advisor and none of this is advice. You need to be responsible for your own decisions, but hopefully that provides a little bit of entertainment to you. These are my thoughts and my opinions only, and you should always be careful of who you listen to and the action that you take in your investment life. So I wish you all the best, and I'll be back for another video talking about the rig market, the offshore rig for oils, and hopefully see you there.